Now, SEBI, the markets regulator, has approved major reforms to expand investment opportunities in real estate and infrastructure. Now, SEBI is going to classify REITs and InvITs, those funds when it comes to real estate and infrastructure. Now, those are going to be classified as equity investments. They are going to be seen as equity instruments, which makes it easier for mutual funds to invest in these sectors and open the door wider to retail investors. So that's a big shift as far as SEBI is concerned. It's a big development, and we are going to get more perspective on this from the experts and get perspective from my colleague who's been tracking the SEBI board meeting that has just concluded. So from the big takeaways right now, as we see it, SEBI has approved these major reforms to expand investment opportunities in real estate and infrastructure, classifying REITs and InvITs as equity instruments. And that, like I mentioned, makes it much easier for mutual funds to invest in these sectors and opening the door wider for retail investors. So a lot of potential as far as the kind of decisions that has been taken by SEBI in trying to, of course, revise the minimum public shareholding rules as well, what it really means for listed companies and for promoters. That's going to be closely watched. This relaxation that we are seeing in the minimum public shareholding norms, it will have to be seen whether it boosts IPO activity and ease pressure on promoters, or is this going to reduce transparency in the market, is something else that we are putting on our radar. Also, this move could benefit some of the new age tech companies in particular, because sometimes these are the kind of companies that struggle with meeting MPS norms, and that happens soon after listing. So we'll have to see exactly how that works out. But also investors are perceiving this as a dilution of governance standards. Perhaps at some level, it could be seen as an ease to get that much more domestic action in the markets. So investments flowing in to the equity markets because of these decisions, you cannot quite rule them out. In fact, the market experts are going to be able to tell us exactly what difference we are likely to see once these bits are coming through. And of course, we are waiting and standing by for the board meeting, the SEBI board, to address the media. They've gathered over there. It's going to be an important piece. Let's just listen into what they're saying.
SEBI board meeting. It is now my privilege to invite SEBI Chairman Sri Tuinkant Pandeyji to address you. Following his address, we'll open the floor for questions. Each of one of you are requested to limit yourselves to 1 or 2 questions. And please mention your name and name of the media organization before putting on the questions. Thank you. Over to you, sir.
So good evening, friends. The SEBI board met today, and I will just explain to you some of the decisions. The first one is relating to the minimum public offer and the timelines to comply with minimum public shareholding for issuers in terms of SCRR rules. Now, these SCRR rules are notified by the government. So the board has only a recommendatory power here. The actual decisions will be taken by the government, and then as per the decisions, then due notification will take place in due course. As you know, the public consultation papers have been circulated and comments have been received. It has also been discussed in the committee, which is relevant to the primary market. So one of the main issues being faced in the large issuers, they face challenges in undertaking substantial dilution of equity shares through IPO, as large offerings may be difficult for the market to absorb. These constraints can act as a deterrent for large issuers from considering listing in India, thereby limiting the investment opportunities for the Indian investors. So now we are recommending, the board has recommended that there are 2 share thresholds: post-issue market cap One is 4,000 crore to 1 lakh crore. So there's no change before that. The post-issue market caps, less than 4,000 crore remain as it is. But we are creating 4 more thresholds after the 4,000 crore. 4,000 crore to 50,000 crore, 50,000 crore to 1 lakh crore, 1 lakh crore to 5 lakh crore, and more than 5 lakh crore. Then for 50,000 crore but less than or equal to 1 lakh crore, in this category, it is proposed to revise the minimum public offer from the current requirement of 10% of the post-issue market cap to 1,000 crore plus 8%, at least 8% of post-issue market cap. So this is a scale-based thresholds we are bringing. Now for 1 lakh crore and above, so it will be 6,250 crore and at least 2.75% of post-issue market cap. So this is plus, and which is market cap above 5 lakh crore, it will be 15,000 crore plus 1% of post-issue market cap. There is another proposal regarding the timelines. Now, where we have the post-issue market cap above 50,000 crore but less than or equal to 1 lakh crore, is proposed that the timeline for compliance with the MPS requirement of 25% may be extended from the existing 3 years to 5 years from the date of listing. The next proposal in this chain is that wherever the post-issue market cap above 1 lakh crore, it is proposed that the timelines to comply the MPS will be bifurcated into 2 buckets. If it is the public shareholding is less than 15% as on the date of listing, then MPS of 15% is to be achieved within 5 years and 25% within 10 years. In case public shareholding is 15% or above as on the date of listing, then the MPS of 25% is to be achieved within 5 years from the date of listing. Under the current rule, MPS of 10% is to be achieved within 2 years and 25% within 5 years, which is now being changed, in terms of recommendation. Now, the proposed extended timeline, of course, may also be grandfathered, may be made applicable to the listed entities who haven't achieved MPS still, but whatever shortfalls, whatever fines are happening, that will continue due to the non-compliance till, of course, the new rules take into effect. Another important proposal in this regard is, if you recall, that there were initially a proposal to reduce the retail reservation for retail individual investors from 35% to 25% in order to address the same problem. Now that this problem is being addressed through change in structure of the MPO, so therefore a reservation for retail investors is being retained at 35% of the net offer. Now I move to the next proposal. The next proposal relates to the amendment to SEBI ICDR Regulations 2018. The purpose is again ease of doing business and also ensuring that the existing limits on anchor investors, they are constraining fund level participation by large FPIs in terms of numbers of anchor investors. Also, there is lack of reservation for long-term institutions like insurance companies and pension funds limits. and this limits diversity in anchor books. So therefore, the amendments, number one, we are proposing that the anchor investor allottees, I mean, there are two categories. There will be only two categories now. So there is another category, anchor allocation up to 10 crore. That category 1 and category 2 is being merged. So it is less than 250 crores, up to 250 crores allocation and more than 250 crore allocation. So one is the category change. Secondly, reserve 40% of anchor book for mutual funds, life insurance companies and pension funds, in which 1/3 of the reservation will be for mutual funds solely, and the balance 6.7% will be for life insurance companies registered with ADI and pension funds registered with PFRDA. Again, this has been due to during the long deliberations in PMSE deliberations, and consultation paper was also released and comments had been received as well. The next proposal is relating to amendment to SEBI list LODR regulations and the circulars thereunder, for the objective of facilitating ease of doing business related to related party transactions. Now, in this category, we are addressing the following issues. The current provision at Regulation 23, subsection 1, sub-regulation 1 of LODR requires shareholder approval for RPTs exceeding 1,000 crore or 10% of consolidated turnover of the listed entity, whichever is lower. This has become onerous for listed entities with high turnover. Okay, before I come to the proposal, let me make it clear that the related party transactions, so far as the disclosures are concerned, so far as the audit committee approval is concerned, nothing is being changed. So therefore, disclosure will remain as it is. The audit committee, you know that they are chaired by independent director, and it has to go through RPTs, have to go through the audit committee. That will remain the same as well. Only the shareholders' approval. If some of the material RPTs go for shareholders' approval, and what I'm saying is a change is only for the shareholder approval, where it is become